welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Budget 2019 hasn't ushered in too many sops for the common man, but it does seek to increase tax on the super rich. There's some relief if you're looking to buy an affordable home, and there is higher tax burden when it comes to life insurance policies. We will decode the fine print of the budget in this week's show, and joining me to do that are Ashish Shankar, Head Investment Advisory at Motilal Oswal Private Wealth Management, Preeti Khurana, Chief Editor at ClearTax, and in a bit we'll also have with us Sanjeev Bajaj, Vice Chairman and Managing Director of Bajaj Capital. Thank you very much for being with us on the show. So it's we're just getting through all the fine print and the impact of some of the budget measures. And Ashish, I'm going to start with you. I'm sure a lot of your clients, the super rich, would not have been too happy with this year's budget.
Yeah, Surabhi. I mean, first of all, it's always a pleasure to be on your show. The tax increase this time has been very, very steep for super HNIs. Earlier, you had one slab, which is a surcharge of 15% for incomes above 1 crore. This time around, they've introduced two new slabs, which is for incomes between 2 to 5 crores and 5 crores and above. And the surcharge is very steep. So between 2 to 5 crores, it's about 25%.
So 15 becomes 25% for this category.
For this category. Crores, yeah. And 5 crore and above, it becomes 37%.
Yeah.
So that's a large increase. Now, it's understandable why the government has done this, because the GST as well as the rest of the tax collection numbers have been scaled down. So they had to find more taxes from the personal tax segment. If they didn't want to tax the common man, which is people with lower incomes, they had to rely on this category of investors. Having said that, it also, not just that it is very, very steep, it also opens up all kinds of other arbitrage in terms of taxation, which we can talk about a little later in the show.
We will talk about that, because it's had a sort of a multiplier effect on several other aspects as well, including the capital gains tax regime itself. Let's bring in Preeti. Preeti, so, as Ashish said, the hope this year was that maybe there'll be some tax regime which gives money in the hands of the common man. That's not happened. But your takeaway on some of these changes, specifically on the hike in surcharge?
Right. So, in my view, we have to look at both the interim and the July budget as a single, in a single approach, because both the budgets actually apply to the same financial year, which is 2019-20. So, if you look at it holistically, of course, those people who are earning up to 5 lakhs, those who are able to restrict their taxable income to 5 lakhs will pay zero tax. And then HNIs who are beyond 2 crores or above 5 crores will end up paying higher tax. Now, the approach of the government has been to keep increasing this surcharge. Like if you do a historical review, you will see that surcharge has been increasing consistently, and in fact as of today at 37%, it's even higher than the 30% rate itself. So surcharge is pretty high. I think it needs a completely different approach to the way we want to tax people. So they have to sort of look at better and innovative ways of taxing, of shoring up revenues, but this has actually sort of been very steep. So 47%, 42% almost for those who are super rich, pretty steep in my view.
Well, the counter, Preeti, that I heard some people put out was that, it's actually not really out of line, because some of the developed economies as well, for instance, the US, also has a peak rate of close to 40% for those who are quite rich. Would you agree?
So in that sense, if you look at purely the tax rates, I mean, you have to look at other indicators also. What are the benefits that come when you pay your taxes? What are your health services like? What are your security services like? And those have not significantly changed. So this appears to be only as an objective, where you're able to slightly increase revenues. There's not much impact on the revenues if you look at it from a collection standpoint. It appears more as like, a strategic aim to sort of tax the super rich, which is easier, and use the surcharge route. Now, when you increase the surcharge, what happens is that the center gets the entire revenue. Whatever direct tax collections happen, those are also sort of in some complex way distributed to the states, but whatever surcharge collections happen, those directly go to the central government.
Sure, I take your point. Yes, this is what experts have pointed out, that the fact that the surcharge collection goes only and only to the central government, and that's perhaps their way of ensuring that their tax kitty doesn't look too poor. But what has happened, Ashish, as we just discussed, is that there is a spillover effect.
Yes.
What we realized was that obviously surcharge is going to be applicable to the long-term capital gains tax or even the short-term capital gains tax. And because of this steep hike in surcharge, now the rates of tax on capital gains go up as well. What impact is this having on HNI investment and just the entire approach?
So if you look at the 2 to 5 crore and 5 crore plus category, what happens now is that even the short-term capital gains as well as the long-term capital gains go up because of the surcharge. So the long-term capital gains now go up to as high as close to 14% for super HNIs who are earning more than 5 crores. And the short-term capital gains go about 20%. Now what happens then is especially for equity-oriented mutual funds, the dividend plan becomes more attractive because the dividend plan has a base taxation of 10% plus 12% surcharge. So I think it opens up the route for more tax planning, and people will have to revisit how they build their mutual fund portfolio.
So if you could elaborate on this, how is it that the dividend route of mutual funds will still be more tax efficient?
Right. So for example, let's assume that I put money in the growth plan. Now, if I put money in
and you're talking about someone who is in, let's assume in the 5 crore plus bracket, where the peak tax rate now stands at 42.7%.
Yes.
And the LTCG rate, just to be clear about it, if you're earning over 5 crores, then the long-term capital gains tax liability is now about 14.2% for this category.
That's right. The base rate is 10%. With the surcharge, it goes up to 14%. So if I invest in the growth plan and I were to redeem my equity mutual fund before 1 year, short-term capital gains gets applied.
Which is around 21.5%.
Which is 15% plus the 37% surcharge goes up to 21%.
Yes.
Whereas if I take the income by way of dividends, then what happens is that the dividend taxation applies before the dividend is paid out. But in the hands of the HNI, the entire money is tax-free. So the dividend taxation is 10% plus 12% surcharge. So the total taxation comes to about 11.45%. So 11.45% compared to 21% is a huge arbitrage.
Big differential
so that's one. Second, even if you look at the long-term capital gains, if I book out of an equity-oriented mutual fund after a year, the total tax that I pay is 14% because the base taxation is 10% and
then the surcharge.
You pay the surcharge of 37%. Whereas if you take the dividend plan, you still end up paying only 11.45%. So in both cases, the dividend plan becomes more attractive, especially for somebody who's investing in an equity-oriented mutual fund. So similarly for debt investors, arbitrage funds become that much more attractive because in arbitrage funds, you can take the dividend reinvestment plan and get a higher tax-free income.
So do you see a preference for dividend plans now across the mutual fund spectrum?
Yes, definitely. In fact, a lot of HNIs are re-looking at their portfolios and trying to see how best to plan the portfolio from a tax aspect.
So it would actually go slightly against the overall thesis of wealth management because I'm sure, experts like you would not advise dividends unless you really require the money. The growth plans have always been promoted and propagated, right?
Yeah, absolutely, because you get the effect of compounding in a growth plan. But after this, new clause,
tax hike,
you'll have to look at, the post-tax aspect, and we would recommend a dividend reinvestment plan in lieu of a growth plan. So the money gets reinvested back into the fund, but the total amount of cash that you have in your hand at the end of the tenure is much more than if you were invested in the growth plan. All right,
do stay on. We need to take a very quick break. When we come back on the other side, we also talk about a small hit that's coming in on your life insurance policies because there is an increase in the tax deducted at source even there. Back in a moment with that.